The day just about everyone has been waiting for has finally arrived.
The Governing Council decided monetary policy no longer needs to be as restrictive and lowered the policy rate by 25 basis points to 4.75%.
That's Bank of Canada Governor Tiff Macklem at a press conference earlier today announcing the first interest rate cut since March 2020. So why now? What's next? And how quickly or slowly will Canadians see rates continue to go down? To answer these questions and more, we have Scotiabank's chief economist, Jean-François Perrault, as our guest this episode. He'll speak with Armina Lagaya to break down everything you need to know about this big announcement. I'm Stephen Maurice, and this is Perspectives. Now, here's Armina Lagaya.
JF, welcome to the show.
Well, thanks, Armina.
And as our listeners might be able to tell, you're not joining me in the studio today. You're actually at the airport right now.
Yes, I made the foolish decision to travel on a Bank of Canada decision day. And maybe like the most important of the year on top of that.
Thank you for making the time. Really appreciate it.
You're very welcome.
We don't want you to miss your flight, so let's get right into it. We are recording this on Wednesday, June 5th. So today's Bank of Canada announcement is a cut of its benchmark rate, the first in 4 years. What is your take on it?
Well, it's a bit of a surprise relative to what we thought was going to happen. We thought they were going to cut a little bit later in the year, but of course, it's a welcome surprise in many respects. I mean, obviously, higher interest rates have been a burden on Canadians, and the sooner we get that relief, the better. Our hope is simply that the timing of the cut this time around, or the timing of this cut, is conducive to a series of follow-up cuts that will occur for the remainder of the year. And we're optimistic on that front, cautiously optimistic on that front.
To follow up on that, you had thought that Macklem might or should wait until later in the year. Why do you think the Bank of Canada cut now? Is this the right call?
It's not 100% clear. I mean, clearly inflation's coming down, so they take a lot of comfort from that, as do we. They point to things like growth in the first quarter being a little bit lower than what they had expected, which is true. But consumption growth is really strong and investment growth is really strong, which I think is what the governor noted in his press conference. So it's a bit of a mixed bag of data. The underlying economy is a little bit stronger than expected, but inflation, which she puts a lot of weight on, is more comforting from his perspective. So he felt that this was the right time to start a process of gradually cutting interest rates.
And just to put it in context for our listeners, inflation is still the last reading from April at 2.7%, so not quite at their 2% target. Are you confident that it'll get to that 2% target with this cut?
We certainly hope so. And as the governor indicated, 2.7 is not 2, which is the target. So there needs to be significant progress going forward still to meet the 2% objective. And that's been our forecast for a while. We think this is going to happen early in 2025. So we don't think this move kind of imperils that in any meaningful way. But it does raise some questions. For instance, one of the considerations that we had going into this meeting in terms of the timing is what kind of impact is it going to have on the housing market. Clearly, people are waiting on the sidelines. We know this. And it's the right thing to do, given the fact that rates were expected to come down. Now that rates are coming down, and since the governor's indicated not only are they coming down today, but we're going to keep cutting, we do think this is going to lead to a fairly significant rebound in the housing market. And there's a potential there that if that rebound is too strong, maybe that imperils further rate cuts, and maybe that creates a little bit more inflation than we'd like. So there's a bit of a risk associated with moving earlier rather than later, but evidently it's a risk that the governor feels comfortable in taking.
Mm-hmm. I will come back to that point about what we can expect in the months ahead in terms of future decisions. But to follow up on what this cut would mean for Canadians, obviously mortgage holders and would-be home buyers have been long waiting for this. Businesses as well. What does this cut mean for Canadians in the months ahead? How will they feel the difference in this?
Well, obviously, as you indicated, Canadians with variable rate debt are going to be paying less at some point. 25 basis points is not a big cut in interest rates, obviously. But I think what's comforting is that we have launched the process of gradually lowering rates. So while 25 basis points is not a lot now, there'll be 100 basis points maybe by the end of the year, early next year, and there'll be a little bit more than that as we go through next year. So I think what's really comforting about this is the rate relief that folks have been hoping and expecting to see gets concrete now. It is starting to happen. And that's great news. That's great news for Canadians that have debt. What's also interesting is, as at least certainly the way we think about it now, given the fact that they moved today as opposed to later in the year, it does provide scope for a greater amount of rate cuts this year than we thought was going to be the case. So we might actually see a little bit more interest rate relief than we'd anticipated this year, which of course benefits Canadians and individuals and businesses marginally more.
So that leads me to my next question in terms of what is next? What can we expect? How many more cuts can we expect this year? How fast or slow will that happen?
Our read of the governor is that he's in a bit of a rush to cut. Now, he didn't say he's in a rush to cut, but he moved a little bit sooner than we thought. And for us, there's a signal there. He's seeing something there that suggests that he should go sooner rather than later. And as a result of that, we now think that they're going to cut at each of the next meetings. So there's a meeting in July, there's a meeting in September, there's a meeting in October. Cut at each one of those meetings and then take a pause, maybe in December. The next meeting after that is December. Maybe take a pause, see how things work out for a little bit. And that's certainly changed our perspective relative to how we thought of things. So sooner and more rapid pace of rate cutting than thought yesterday or earlier this morning.
So that's the outlook for this year. What about next year? What can we expect to see?
I don't think things change all that much next year based on the decision today. We still think rates in Canada fall to 3.25. So we're at 4.75 now. We were at 5 yesterday. A faster pace of rate cuts means that maybe you hit 3.25 a little bit earlier than what we'd had before. But, that's at the margin. Like maybe that happens in the fourth quarter or third quarter. By that time, Canadians will have experienced a significant amount of rate relief. And, that last additional cut's not going to do a whole lot of difference.
I wonder if we can just zoom out a little bit and look at the broader economy. Is this the so-called soft landing that we had been hoping for? Are we through the worst of it, or is there still a risk of a recession?
It certainly looks like we're through the worst of it. When you look at the most recent economic data, so we had first quarter GDP, which was released last week. And even though it was weaker than expected, consumption was pretty strong. Investment was pretty strong. Real estate activity picked up. And as we looked, for instance, to the most recent bits of monthly information we had in the month of April, we created 90,000 jobs, which is extremely strong. There are indications that retail sales in the month of April as well were pretty strong. So the data are coming in reasonably positively, which in our mind kind of rules out the possibility of a really bad outcome or kind of a recession. So yeah, it kind of looks like the economy's stuck the landing, because of course what we expect going forward is as rates come down, people will change their behavior, right? They'll have a little bit of money to spend. We know Canadians have been saving like crazy, and the savings rate in Canada is 7%. Historically, it's about 3%. That is because interest rates are high. So we expect that to start to fade as the year progresses and as those rate increases start to be felt. So we expect a pickup in activity in the second part of the year. Nothing dramatic, but that certainly was consistent with the impacts of lower interest rates. So if we haven't seen kind of the really bad stuff yet, we're unlikely to see it going forward as the Bank of Canada cuts rates and we start to feel the impacts of that.
Macklem did signal that it would be reasonable to expect more cuts, but at the same time, moving too quickly would, to use his words, jeopardize the progress made so far. And any decision would obviously be dependent on the data as it comes. What are the things that Canadians should be looking for that will tell us what the path ahead in terms of cuts would be?
I think at this point, it basically boils down to, is inflation continuing on the path that it's been on, which is a gradually declining path? That's certainly one of the things the governor emphasized in his press conference today. And the fact that, again, that he moved a little bit earlier rather than later, from our perspective, means that he's putting a lot of weight on that inflation data relative to other data, which maybe suggests the economy is a little bit stronger than we'd have thought in some sense. So really, that does sound and look like inflation will be the key. I mean, it always is the key, but even more so going forward in terms of making the space or allowing the governor to cut rates in a sequential pace or, with a pause here and there.
So to wrap up here, what do you think are the 3 key takeaways for Canadians following today's decision?
Well, I mean, obviously, interest rate relief is on the horizon. It's going to feed itself through. So that's an important thing. I think the second takeaway from our perspective is because of the fact that he's moving a little bit sooner than we thought means that he's probably going to cut a little more rapidly than we thought. So not only do we get interest rate relief, but maybe a little bit more of it this year than we thought. And third is because we are now at a point where rates are on the way down, you should expect the rate-sensitive parts of the economy to start improving. So the housing market, maybe consumption spending, maybe auto sales, all things that are pretty dependent on interest rates, and we know they've been held back by higher interest rates. So, look forward to a little bit stronger growth in the second part of the year now.
Thank you, JF, for your analysis today, particularly from the airport.
Thank you very much.
I've been speaking with Jean-François Perrault, the Chief Economist at Scotiabank. The Perspectives podcast is made by me, Armina Lagaya, Stephen Maurice, and our producer, Andrew Norton. The clip you heard in the intro was from the Bank of Canada. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time.